Hello, hi, all. Happy evening. Just due to some technical issues, we are just running a bit delayed from the announced schedule. So, but no worries. We'll just manage. So, in this session, we are going to discuss about the Super 30 questions for the examination, which is going to happen tomorrow, right? So, just in this backdrop, so having exams tomorrow, first, my humble advice to you all would be don't panic and don't read anything new at this point in time. Okay, so whatever we have read till today is finally enough for you to clear the examination. Okay, அதனால எக்ஸாம் பார்த்து பயப்படுறதுக்கோ இந்த பாயிண்ட்ல எதுவுமே இல்லை அண்ட் புதுசா எதுவும் இந்த பாயிண்ட்ல படிக்க வேணாம். ஸோ வாட் எவர் ஹாஸ் பீன் கம்ப்ளீட்டட் டில் டே ஜஸ்ட் ரிவைஸ் இட். அண்ட் வாட் இஸ் தி பர்பஸ் ஆஃப் திஸ் செஷன் அப்படின்னு பார்த்தோன்னா, ஸோ வி ஆர் ஜஸ்ட் டேக்கிங் சம் கொஷன்ஸ் so which we are expecting in the examination, either the same question or the concept which could be tested, so which could easily help you to boost your score in the exams. So that is the objective of this session, right? So in the session we will focus more on question solving, right? So wherever required, there alone we'll just go for concepts. Okay, ரொம்ப conceptual discussion போக மாட்டோம் until or unless. So whatever we are discussing, so mostly all these questions are taken either from the RTPs, MTPs, or the suggested answers for CMA intermediate, which whatever has been published, and whatever we are expecting. So maybe in the question, or it could just be twisted. So the same question could be twisted a bit in the examination, or the concept could be tested. So that is what is the objective of this session. And in this session, we'll just focus on direct taxes alone. Right. So let us not waste some more time and let us directly jump into solving the problems. Yeah. First, let us go to question number 1. So question number 1 is from income from house property, right? So this is a co-owner problem. This is a standard problem actually. So it was one of the previous attempt questions, and we are just modifying it to the current assessment year and provisions related date. Right. So the question goes this way. Two brothers, Rama and Shankar, are co-owners of a house property with equal shares. The property was constructed during the financial year 98-99. The property consists of 8 identical units. The property consists of 8 identical units and is situated at Salem. During the financial year 22-23, each owner occupied 1 unit for residence, and balance 6 units were let out at a rent of 14,000 per month per unit. The municipal value of the property is 9 lakhs, and the municipal tax are at 10% of the municipal value, and it is paid during the year. Okay. The other expenses are as follows: repairs 90,000, insurance premium 15,000, interest payable 3,50,000. One of the let out remained vacant for 4 months during the year. Rama could not enjoy his unit for 6 months as he was transferred to Bangalore. He does not own any other house property. The other income of Rama and Shankar are 3,50,000 and 1,80,000 respectively for the financial year 22-23. The co-owners received during the year 1,40,000 as unrealized rent for financial year 14-15 and rupees 50,000 as arrears of rent. Compute income under the head house property and total income. So this question consists of 2 parts. Part 1 will be to compute the total income from house property, and the second part would be to compute the total income of the two brothers. Right. So in the question part, first thing, how to read a question in the examination. So whatsoever, before reading any of these stuff, which is the stories or whatsoever it may, first read what is required from you from the question. So question, how should we read the question is, go straightly to the last para. So what is the requirement from this question? Compute the income under the head house property and total income of two brothers for the assessment year 23-24. Why should we read this first? Is some questions will require you to compute only the income under a specified head, and some questions will require you to compute the total income. So reading a question for a specified head of income will be different from reading a question for total income, primarily for one reason, that chapter 60 reductions and other incomes can be omitted if you are just going to go for a specified head of income under a specified head. If you're going to go for total income, all those things would matter. And also read whether tax payable is required. If tax payable is not required or tax liability is not requested in the question, just don't go for computing the tax liability, because it is just going to cause you waste of time. Right. So now let us go and solve this problem. So what is the question? Compute the income under the head house property. Without computing income under the house property, we cannot go for total income. Right. So let us just go back to the question and let us just highlight few things which is required. So first one is the property was constructed during the financial year 98-99. So what does this mean? Your interest deduction will be limited to 30,000 because for you for a self-occupied property for 2 lakhs to be claimed, you should satisfy certain conditions. One of such condition is the loan should be availed after 2000. Correct. So here it is availed before 2000. Hence, your interest deduction will be limited to 30,000. That is point number one. Second point, there are 8 identical units and 2 is occupied. Each owner occupied 1 unit for residence. Each owner occupied 1 unit for residence and 6 units are let out. So totally 2 self-occupied properties and 6 let out properties, right? So per month rent is 14,000. The municipal value is 9 lakhs and municipal taxes are 10% of municipal value. So 10% of municipal value, and this municipal value is for the entire property, correct? Because this is a single property having multiple units. Basically, it is like a flats having 8 identical units. Okay. So 10% of the municipal taxes, municipal value is paid as municipal taxes. So of this, only for let out properties, we can claim municipal taxes deduction, correct? So that is one point which is to be noted. The other expenses, this repairs, you cannot claim it as deduction, and insurance premium, you cannot claim it as deduction, whichever. And the next point is interest payable on loan taken, rupees 3,50,000. Of this 3,50,000, what we should do is for the self-occupied property, it should be limited to 30,000. For the let out properties, there are no limit, right? So one of the let out remained vacant for 4 months during the year. You can claim vacancy allowance. The 4 months rent can be reduced from the annual value. Next, Rama could not occupy his unit for 6 months as he was transferred to Bangalore. Even though he was transferred for Bangalore, for a property to be self-occupied, if he could not occupy it on account of his business or employment, that will still continue to be his self-occupied property. Hence, even though he could not occupy it for 6 months period, you cannot treat it as deemed to be let out property, right? Or vacant property. It should be treated as self-occupied property. Next, he does not own any other income. The other income are 3,50,000 and 1,80,000. So we need to add this in the second step. The co-owners received during the year 1,40,000 as unrealized rent and 50,000 as arrears of rent. So both of these, it should be added in the current year's income from house property after taking 30% of deduction under 24A. Okay. So that is one point which we should remember. It should not go to the rent received or receivable. It should be treated in shown in a separate line item. Let's compute the income under the head house property. That's it. So now let us first start. So what is the municipal value of the property? So what is the municipal value of the property? So total, the entire municipal value is 9 lakhs. Of that 9 lakhs, 6 units is for let out and 2 units is self-occupied. So first let us find out the income from house property for let out properties. Okay. So in the let out properties, we have 6 properties out of 8 properties, which is 75%. So 75% of the municipal value is 6,75,000. Okay. Next is actual rent. So as far as the actual rent is concerned, so what is the actual rent per month? 14,000 per month per unit. So totally there are 6 units which is let out for the period of 12 months. Okay. Of which 14,000 for 1 unit for 4 months is vacant in the pointer. Is vacant for 4 months during the year. Hence, this should be claimed as deduction. This 14,000 should be claimed as deduction, and your answer would become 95,200, 95,200, 6,75,000. Higher of the above should be taken as gross annual value. So what is the higher of A and B? It is 9,52,000. Okay. Next, less municipal taxes. So as far as municipal taxes is concerned, we have already discussed that. For the let out properties alone, you should take the municipal taxes paid as deduction. So what is the proportionate amount? 9 lakhs is the entire municipal value. For the let out property, municipal value is 6,75,000. So 6,75,000 into 10%, it is going to give you 67,500. And this 67,500 is to be claimed as deduction. 67,500. Right. Next, you should add unrealized rent here and arrears of rent. So both of them is to be added here, which comes to 1,90,000. We've already discussed this. So as far as the unrealized rent and arrears of rents are concerned, you can claim only 30% of 30% of NAV assets deduction under 24A, right? So on the point, we'll just add it. So it is 1,90,000. Now we should get what is the net annual value. So as far as net annual value is concerned, so we should add all these three items: 9,52,000, 9,52,000 plus minus 67,500, 67,500 plus 1,90,000, which is going to be 10,74,500. Of this 10,74,500, we can claim 10%, 30% as reduction under reduction for NAV, right? 30% as reduction for NAV. So 10,74,500 into 30% into 30%, which comes to 3,22,350, right? So this 3,22,350 can be claimed as reduction. Next is interest on house property loan which is taken. So as far as interest is concerned, for the 75%, that is 6 units, whatever is the proportionate interest that can be claimed as reduction in full. There is no restriction for claiming interest deduction for let out properties, right? So 262,500 in entirety can be claimed as deduction. So what is going to be my income from house property? 10,74,500 minus 322,350 minus 262,500, which is going to be 4,89,650. 4,89,650. So this is going to be my income from house property for all the 6 units. 6 units in total is the correct. Next, let us go. This is for the let out property. Now let us go for the self-occupied property. So as far as self-occupied property is concerned, the net annual value is going to be 0, which is just focus on the interest deduction part. Right. So there 75% of the interest is computed. Here we should take the 25% of the interest, and for 2 people we just need to divide it. Right. So here we will be getting, if we just check for 3,50,000 into 25%, but as we have already discussed, since the loan is taken before 2000, it is to be limited to 30,000, correct? So 30,000 should be claimed as reduction here. So the loss from house property is going to be 30,000. Here also it is going to be 30,000, right? Next is income from house property for let out properties. So we should divide this by 2 and share it for both the people, since the shares are visible. What is going to be my total income from house property? Total income from house property is 244,825 minus 30,000, which is going to be 2,14,825. 2,14,825. So from to this we should add these two, the other income, to find out the total income of the assessees. If you just see here, I will just add it here itself. Yeah. So this is going to be my total income from house property. Next, I should add income from other sources. What is going to be my income from other sources? For Rama, it is 3,50,000 and 1,80,000. For Shankar, 380, and for the other person, it is 180, 350 and 180. 3,50,000, 1,80,000. Right. So my total income is going to be 214,825 plus 350 which is going to be 564,825, and for Shankar it is going to be 214,825 plus 180, which is going to be 394,825. So one point which we should just remember here is, in our subjects and even in the act, it is said that you can claim two house properties as self-occupied properties, correct? But to claim that, it should actually be self-occupied either by you or your parents. It should be self-occupied by you. If it is let out, you cannot go and ask for the self-occupied concession, which gives you as the net annual value of the property as 0. Okay. So for a property to be considered as self-occupied property, basically in act we have two concessions for two house properties which can be claimed as self-occupied properties. And the rental varnona, so one point which you should just remember is, it should compulsorily be self-occupied. If it is not self-occupied, you cannot claim the net annual value as 0 concession. Right. So with this, our first question comes to an end. So as far as this session is concerned, what we'll plan is, we'll just break it into two parts, part 1 and part 2. So part 1 first we'll complete, just for the sake of timings. So first we'll complete and we'll upload it in the YouTube. So while you complete watching first part, you will be having the second part. That is the plan. Right. Now let us go to question number 2. Question number 2 is also income. We should compute income from house property of Tarun for the assessment year 23-24. Right. So for this question, Tarun is employed in a private company, commenced construction of a commercial complex. In July 2021, he borrowed rupees 50 lakhs from a bank at 9% per annum. Interest up to 31/3/2022 was 2,20,000, and for the period from 1/4/22 to 31/12/22, rupees 2,30,000, 1,40,000 towards interest for the balance 3 months remained unpaid. The construction of the building was completed on 31st December 2022. The building was let out with effect from 1/1/2023 for a monthly rent of 90,000. Municipal tax of rupees 1,20,000 was paid by cash on 10/1/2023. He repaid rupees 1,90,000 towards principal during the previous year 22-23, of which he paid rupees 1,20,000 up to 31/12/2022. Right. So as far as this question is concerned, this was given in one of the previous somewhere around 2019, I guess, in the 2019 suggested answer. But what we should understand is, there is a Supreme Court judgment in the case of Chennai Properties and Investments. So prior to that, whatsoever income you are having from, if you are going to receive rent, it was compulsorily liable to be taxed under the head income from house property. Right. But after that, in case of Chennai Properties and Investment, it was held that if your primary business is letting out of properties, that income is to be taxable under the head PGBP and not under the head income from house property. So what were the principles? One of the principles which was laid down is, based on articles of association and memorandum of association, if the primary principal objective of a company is to let out properties, that was used as one of the parameters to treat the rental income under the head PGBP and not under the head income from house property. Okay. So in the question, what we are going to take an assumption is, we are going to assume letting out of properties is not the primary business activity of the individual. So only if you are having this assumption, the answer which I am going to work out now is valid. If you are going to take the assumption otherwise, that is, if you're going to assume the letting out of properties is the primary business of the individual, then what will happen is, this income is to be taxed under the head PGBP and not under the head income from house property. So for want of time, what I'm doing is, whatever is given in the suggested answer, we are just discussing the same answer. We are just adding this assumption, and in the suggested answer, the assumption is not given. So, but I personally feel without this assumption, this answer is not valid. Right? So if a same or a similar question comes in your examination, have this assumption. The reason is Supreme Court decision in the case of Chennai Properties and Investments, are just right, Supreme Court decision. That's it. That is also fine. Okay. So now let us go to the computation of income from house property. Right. So here the municipal valuation, it is given us. So first let us once again read the question and decode the question. So he started construction on July 2021. Right. He borrowed rupees 50 lakhs at the rate of 9% per annum. So up to 31st March 2022, it was 2,20,000. And for the period from 1/4/22 to 31/12/22. So 31/12/22 is the project completion date, correct? So 1/4/22 to 31/12/22, it is 2,30,000. And after from 1/1/22 to 31/3/23, it is 1,40,000. Right? So the building was let out for a monthly rent of 90,000 from 1/1/23. That is when the property was made ready for occupation. Next, the municipal taxes of rupees 1,20,000 was paid by cash on 10/1/2023. He repaid rupees 1,90,000 towards principal during the previous year 22-23, of which he paid rupees 1,20,000 up to 31/12/2022. So if this question is going to ask you to compute income from total income, we should check if this 1,90,000, which is paid towards the principal, can it be claimed as deduction for ATC? Since it is not given and we are just going to compute income from house property, that information is not required. That's what I said. First, we should read what is required from us from the question. So if they are going to require from us just to compute income under specified head, we shall leave out the details which is requesting us to consider provisions of other chapters. Right? So that is the reason why we should first read the last line or the last para of the question and then read whatever is given outside. Okay. So now let us coming back to our question. So the municipal valuation of the property. What is the municipal valuation of the property? Municipal tax is this one. Yeah, municipal value of the property is 9 lakhs. So if the property is let out for a part of the year, if it is only available for part of the year, then we should take the proportionate municipal value. So what is the proportionate municipal value? It is 9 lakhs into 3/12. That is the period during which the property is let out, which gives me 2,25,000. And the actual rent here is 2,70,000. So 90,000 per month, monthly rent of 90,000 per month from 1/12/2023. 1/1/2023. It is for 3 months. Okay. So for 3 months, my actual rent is 2,70,000. So my annual value is going to be 2,70,000. Next, municipal taxes. So as far as municipal taxes are concerned, whatever is paid during the year, irrespective of the year during which it accrued, we can claim it as deduction. Irrespective of the year in which it accrues, we can claim it as deduction. So municipal taxes 1,20,000 can be claimed as deduction. So what is going to be my? It is going to be 2,70,000 minus 1,20,000. It is going to give me 1,50,000. Okay. So of this 1,50,000, I can claim 30% as deduction into 30%. 1,50,000 into 30%, which is 45,000. I can claim it as 45,000. I can claim it as deduction, 30% of NAV. Next is interest. So as far as interest is concerned, we should bifurcate the interest between pre-construction interest and post-construction interest. So pre-construction interest, it should be claimed as deduction in 5 equal annual installments starting from the year in which the asset is ready for occupation. Okay. So in the case, when is the asset ready for occupation? On 31/12/2022. So basically, it is ready in this financial year, which is financial year 22 to 23. So the entire interest for the financial year 22 to 23 can be claimed in the current year itself. Okay. So if at the end of the previous year, if at end of any previous year, if the property is not ready, right, if the completion certificate is not obtained, only in such case, such interest is to be accumulated and can be claimed as 5 equal installments. Just to put it again, for me to claim the pre-construction interest, Pre-construction interest is for the for me to compute whether an interest is a pre-construction interest or post-construction interest for that period. So இப்போ வந்து நமக்கு இந்த கேஸ்ல வந்து there are 3 periods up to 31/3/2022 first period, 1/4/22 to 31/12/22 second period, from 1/1/23 to 31/3/23 third period. 3 period இருக்கு. So first period, what is the interest? It is 2,20,000 for 31 up to 31/3/2022. Is the building ready by end of that financial year? No, right? So that is pre-construction interest. Come to the next period, 1/4/22 to 31/12/22. 2,30,000. Is my property ready by end of that financial year? That is for which this period is concerned. So for 1/4/22 to 31/12/22, the relevant financial year is 1/4/22 to 31/3/23. So within this financial year, my property is ready for occupation. So this is not pre-construction interest, this is post-construction interest. And the next one also comes in the same lines, right? So for the current year, this 2,30,000 and this 1,40,000, it is to be claimed as deduction in the current year itself, because this is not pre-construction interest. So this 3,70,000 is to be claimed as deduction in the current year itself. 3,70,000. Next, pre-construction interest, this 2,20,000 alone is to be claimed as pre-construction interest. This one, 2,20,000 is alone to be treated as pre-construction interest. 2,20,000 divided by 5. It should be claimed as 5 acre installments from the financial year in which the property is ready for use. This 44,000 again I can claim it, right? So next is 150 is my net annual value. From this I should reduce 45,000. Next is 3,70,000 and 44,000. So I'm going to get a loss of 3,09,000. Loss of 3,09,000, right? So with this question comes to an end. Now let us go to the next question on income from house property. Yeah. Now let us go to question number 3. So as far as question number 3 is concerned, so it has 3 house self-occupied properties and 1 own business property, right? We are required to compute income under the head house property. Yeah, compute income under the head house property of Mr. A from the following information. Particulars: house 1, house 2, house 3, house 4. It is used for self-occupation 3 and 1 is for own business. So as far as this own business property is concerned, if it is used for the purpose of his business or profession, it will not come under income from house property head itself, because in section 22 itself we have already seen that for something to be considered as income under the income from house property under section 22, it should not be it should not be used for the purpose of his own business or profession, the profits of which are chargeable to tax under section 28. So if you have any doubts in this part, we have already given a video specifically, the entire video on income from house property, you can refer that, right? So now coming back to our discussion, so this house property 4, which is for income from house property, which is used for his own business, it is not required to be computed at all. So totally now there are 3 house properties, right? So one is situated in Mumbai, next is situated in Abu, and the third one is situated in Kolkata. See the gross municipal value, fair rent, standard rent, municipal taxes, repairs, ground rent, land revenue, interest on loan, and when is that loan taken. So for house property 1, it is 98.99. House property 2, it is 98.99. For house property 3 alone, it is 18.99. Right? So these are the 3 house properties. So what is required from us in this question is, any 2 house properties at the option of the assessee can be claimed as self-occupied, and the other property will be deemed to be a let out property. 2 properties self-occupied, 1 property deemed to be let out. Okay, of the 3. It was asked in the before 2020, where before 2019, where you can have only 1 self-occupied property. This question was from that era, but we are just modifying that question for the current law. The answer is modified as per the current law. And one point which I request you to highly remember is, a similar question I just saw in a recent MTP, and unfortunately they have given a wrong answer. In the CMA intermediate MTP, unfortunately they have given wrong answer. they have treated one house property as self-occupied and the other two house property as deemed to be let out. But it is other way around, right? So be very, very cautious of this point. In a recent MTP, if you have seen a question similar to this, just verify the answer whether you're having one house property as self-occupied or two house properties as self-occupied. Currently, the law states that you can have two house properties as self-occupied for sure. There is no doubt regarding that. You can have two house properties as self-occupied. The reason why their answer in the MTP is slide twisted is, it is not twisted, it is wrong. It is primarily because this question was from a suggested answer. This is from a suggested answer, and they have also taken the question from the suggested answer. But answer is also taken from the suggested answer without revising the answer for the current provisions. So with due humble respect, I'm just making this point. For the benefit of students, I'm bringing it to notice. If not, I would have not brought this. For the benefit of students, I'm telling that if you have seen that, don't write the wrong provision in the examination. Some error has happened. So what is required to be done is two house properties are self-occupied and one house property is deemed to be let out. Right? So there are two methods to solve this problem. Right? So first, what we should do is we should consider each single house property individually as deemed to be let out and compute the income from house property. So after computing all the three as deemed to be let out, whatever is going to have the least income is to be treated as deemed to be let out, and the other two is to be treated as self-occupied properties. That is method number one. Method number two is you should compute the entire total income, entire income from house property, and whichever is going to give you the least income from house property, that is to be deemed, that is to be taken as the final option. Right? So both the methods are right. So the first method is more like a shortcut method. So the first method is more like a shortcut method, and the second method is like a detailed method. So there is no wrong in. So there is no wrong in choosing any one method, right? So, but one point which we should just remember is in both the methods you'll get the same answer, right? So now let us focus first on method one. We'll find an answer. We'll then go for method two and find the answer, right? So in method one, we have to deem each specified house property as a deemed to be let out house property individually. For that, first we need to find the gross annual value. So gross annual value is municipal valuation or fair rent, whichever is higher, of that, or standard rent, whichever is lower, is to be taken as the expected rent. So these are very small things. I don't want to get into the numbers. It is pretty much simple. So this is going to be the expected rent: 3 lakhs, 2 lakhs, and 7 lakhs. So 3 lakh, 2 lakh, and 7 lakhs is the gross annual value. And the municipal taxes for a deemed to be let out property, you can claim that as deduction. There is no issues. So this 45,000, 30,000, and 1,05,000. So how did we get this? 15% of the municipal value. So 3 lakhs into 15%, 2 lakh into 15%, 7 lakhs into 15%. So I'm going to get my net annual value after deducting 1 from 2. Next, I need to go for deductions. So 30% of the NAV can be claimed as deduction if it is a deemed to be let out property, and interest on capital. Interest on capital, there are no restrictions if it is going to be a deemed to be let out property. So whatever is the entire interest paid, that can be claimed as deduction. So my income from house property of the three properties, house property 1, house property 2, and house property 3 is 1,38,500, 1,09,000, and 2,06,500. Okay. So this is going to be my three income from house properties individually if I'm going to deem it as let out properties. After computing this is not the end of the answer. After computing this, we need to say which house property is to be treated as deemed to be let out and which are the house properties which we treat the same as self-occupied properties. In this case, we have the least income from house property 2 if I'm going to deem it as deemed to be let out. Right. So house property 2 is to be treated as deemed to be let out properties, and house property 1 and house property 3 is to be treated as self-occupied properties. This is the conclusion of this step. The first step, we need to find out what is deemed to be let out, what is self-occupied. So here we are coming to a conclusion that house property 2 is to be taken as deemed to be let out, and house property 1 and house property 3 can be taken as self-occupied properties. Now what we should do is, so for house property 1 and house property 3, the net annual value is 0. Till here, there are no doubts. Correct? This 1,09,000 is what we have already computed. This is what we have already computed. The house property, income from house property for the deemed to be let out property. Next, interest on capital. Interest on capital is to be restricted to 2 lakhs. Since it is going to be self-occupied properties, the interest on self-occupied property is restricted to 2 lakhs, and income from house property will be 91,000. That's it. Your answer ends here. You need not do this option 2 and option 3 and all if you are going for method 1. Right? You need not do this option 2 and option 3. If you are going for method 1, compute till here, find which property is to be treated as self-occupied, find which property is to be treated as deemed to be let out. After computing that, compute the income from house property, taking the conclusion derived from this step, method 1. Now we'll go for method 2. As far as method 2 is concerned, what will happen is you need to consider all the 3 options. This is a trial and error method. This is more a logical method. This is a trial and error method, right? So totally there are 3 house properties, correct? So house property 1 is to be deemed to be let out. Now what is going to be my income? If house property 2 is deemed to be let out, what is going to be my income? If house property 3 is deemed to be let out, what is going to be my income? So I need to compute it individually. I need to compute the entire income from house property for all these 3 options individually. Okay. So house property 1 and house property 3, I'm going to deem it as self-occupied. House property 1 and house property 3, self-occupied. House property 2 and house property 3, self-occupied. Next is house property 1 and house property 2, self-occupied. So totally there are only 3 options. 1 and 3, 2 and 3, 1 and 2. 3 options. So for all the self-occupied properties, my net annual value is going to be 0. Correct? So for all the 3 self-occupied properties, my net annual value is going to be 0. And this deduction is going to be subject to a maximum amount of 2 lakhs. So for house property 1 and house property 3, if you see the question, here the interest is 40,000, here it is 2,10,000. It is to be restricted to 2 lakhs. Interest on capital is to be restricted to 2 lakhs. Next, house property 2 and house property 3. So for house property 2 and house property 3, if you see here, the interest is 3,10,000. So here again, it is to be restricted to 2 lakhs. Right. Next, it is house property 1 and house property 2. I'm leaving it as self-occupied. So house property 1, interest is 40,000. House property 2, interest is 1 lakh. So in entirety, it is going to be 40,000. Sorry, here the answer is wrong. Just give me a minute. Yeah, it will be 30,000. Right? It will be 30,000. Since it is borrowed before 2001, it is subject to a maximum limit of 30,000. Right? Now, what does this part mean is, if I'm going to deem this as let out property, what is going to be my income? House property 1, house property 2, and house property 3. So we already solved this in step number 1, similar steps only. So house property 1, what is going to be income from house property? 148,500. If you are going for method 2, you will compute this separately. Right. Next is house property 2. House property 2, it is 1,09,000, and house property 3, it is 2,06,500. Now let us compute the total by adding this plus this. 1,09,000 minus 2 lakhs, the loss 91,000. 2 lakhs minus 2 lakhs of loss and 1,48,500 is 51,500. 3 lakhs 30,000 and 30,000 and 2,06,500. Total is 176,500. So here, whatever is going to be my least, I should take whatever is my least income. I should take that as the final answer. Here, in this first situation, the income is least. Hence, I should take that one as the final option. This is 91,000. Here also, what is the option here? House property 1 and house property 3 as self-occupied, and house property 2 as deemed to be let out. I'm getting an answer on this. House property 2 is deemed to be let out. Same option, right? So my answer is going to be 91,000 of loss, right? So with this, question number 3 comes to an end. Let us now go to question number 4. Yeah. So now let us discuss about question number 5. So this question was asked in June 2017. But what we should just remember is this answer requires a slight modification because the provision is changed after that in relation to residential status. Here, Mr. Ramesh is an Indian citizen, gives us the following information for the year ended 31st March 2023. Business income in Mumbai, 2,50,000. Rental income from property let out in London, converted in Indian rupees, 5,40,000. Before that, let us just find out what is required from the question. We are required to compute this total income chargeable to tax in India by giving reasons for each treatment for each item. Right. So now let us get back to the question. So he is an Indian citizen. So he's not a foreign national. He's an Indian citizen. Gives you the following information: business income in Mumbai, rental income from a property let out in London, fixed deposit interest in India from Element Bank, fixed deposit interest from Bank of England converted in Indian rupees 40,000, business consultancy income from Essex Limited in Hampshire, England, being a company incorporated in Delhi, having branch office in England. The business is managed from Delhi. This answer is 75,000. Agricultural income from land located in Malaysia converted in Indian rupees, 90,000. Income from nursery at Alwar, Rajasthan, 1,40,000. Mr. Ramesh returned to India on 15/6/2022 after remaining in England for 10 years. During the last 4 assessment years, he was in India only for 100 days. Determine the residential status of Mr. Ramesh for the assessment year 23/24 and compute his total income chargeable to tax in India by giving reasons for treatment of each item. Right? So here let us compute. So generally, if he is coming to India and if he has come before September, Abdina, definitely he'll be a resident. Okay, wow. So here just let us compute the number of days. 15 days in June, 31 days in July, 31 days in August, 30 days in September, 31 days in October, 30 days in November, 31 days in December, 31 in Jan, 28 in Feb, and 31 in March. So totally 289 days he was in India. So since he has stayed more than 182 days, as per 6.1 first condition itself, he is deemed to be a resident. Next, let us check whether he is a resident and ordinary resident or resident but not ordinary resident. So for a person to be resident but not ordinary resident, 2 conditions are required to be satisfied. He should be a non-resident in 9 out of 10 previous years. So as per the question status given, he is in India only for 100 days in the preceding 4 financial years. So it is satisfied. Second condition is also satisfied because only for the last 4 assessment years we are having it. So in the 4 assessment years itself, if he has stayed only for 100 days, so then the question does not arise. Right? So he has stayed less than 729 days in the preceding 7 financial years. Hence, he is a resident but not ordinary resident. If a person is a resident but not ordinary resident, income which is received or deemed to be received in India and income which accrues or arises in India is alone taxable. Right? So first is business income. Business income, it accrues in India. Since business is in India, business income also accrues in India, hence it is taxable. Next is income from property in London. It accrues outside India since the property is located outside India. In case of a movable property, it is located outside India, hence it is taxable outside India. Fixed deposit interest from Element Bank. This one from in India from Element Bank. Since it accrues in India, it is chargeable to tax in India. Hence, this one is taxable. Next, fixed deposit interest from Bank of England. Since it is from Bank of England, it is not taxable in India. Next, business consultancy income. It accrues or arises outside India and business is controlled from Delhi. If at all it is a business and it is controlled from a place in India, it is required to be taxed in India. Hence, 75,000 is taxable in India. Agricultural income from Malaysia. Agricultural income from Malaysia is not, since it is not from a business set up in India or controlled in India, it is not taxable in India. Next is income from nursery. Income from nursery, we just need to remember that even in the video in relation to agriculture, we have just seen that nursery is a place where the pot plants or the plants which we get in marriages, right? They'll just give it in a cover. So that is the place where those plants are first grown and then they are sold. That place is known as nursery. So the nursery income is a income from agriculture. We've already discussed this. If you have doubt on this, go and refer our agricultural income discussion, which is also free in YouTube. Right? So income from nursery, it is not taxable in India. It is exempt under 10(1). So the total income here is 3,85,000. So we have only 3 incomes which is taxable. One is business income, the next one is fixed deposit, and the third one is business consultancy income. Right? Now let us go to question number 6. So now let us discuss about question number 6, where we are going to discuss about the residency status and total income again. So Mohit left India on 7/4/2022 to UK for employment. He returned to India on 7/11/2022 after resigning his job. He commenced a business on 1/12/2022 and his turnover was 32 lakhs up to 31/3/2023. All the payments for sales were received through crossed account pay checks. He wants to declare income under section 44 AD. His income in the UK was 6,56,000. When he remained outside India, he invested in equity shares of Vodafone UK Inc. He received dividend from Vodafone UK Inc. foreign company rupees 60,000 during the previous year 22-23. He borrowed rupees 2 lakhs from Mr. Narain of Chennai to invest in shares of the foreign company and paid interest of rupees 20,000 for the year ended 31/3/2023. Determine his residential status for assessment year 23-24 and compute his total income. So as far as this question is concerned, it was asked in CMA intermediate in the June 19 examinations. One point which we should just remember is, as such, as I said for the previous question, similarly, this question cannot be solved as the in the method which is given in the suggested answer, because the law is changed, right? So as far as this question is, there are 2 points in this question. One, I slightly differ from the suggested answer on a 1 point, which was given in the what to say. Let me put it this way. Yeah. So there are 2 aspects which are just going to deviate from the suggested answer. One is computation of residential status, determination of residential status. In CMA suggested answer, based on the law which was prevailing in that period, that was perfect. The second part is this point. He commenced the business and he is required to deduct. He wants to declare income under section 44 AD. This point is there, right? I slightly differ here from suggested answer. Suggested answer says that you can declare income under 44 AD even for a non-resident, but I slightly differ. In my view and what I understand from the law and what is given in the law is 44 AD is applicable only for residents. It is not applicable for non-residents, right? And non-residents, generally there are sections like 44B, BB, BBA, triple B. So all these sections are presumptive taxation for non-residents. 44 AD is not applicable for non-residents. Right. So now let us come back to it. With due respects, I just want to make this correction in the suggested answer, because specifically in the law it is given that eligible assessee means an individual or HUF who is a resident. That is the section which is wordings which is given. Right. Now let us come back to our discussion. So now, based on the revised law, we need to make one assumption. I'm just adding this point to the question to answer the previous question, because without this point, we cannot answer this question, which was given in this CMA June 19 intermediate examinations. So on the assumption that his income from business is 16 lakhs, his income from business is 14 lakhs, right? So first, let us find out his number of days stay in India. Now let us go to point number A. Answer. Point number A, on the assumption that business income is 16 lakhs, right? So let us find out the number of days stay in India. Number of days stay in India, that is going to be, so he left on 7/4/2022. So there we are having 7 days in April, right? Then he returned to India on 7/11/2022. So basically it is going to be 23 days in November, 30 days, 31 days in December, 31 days in January, 28 days in February, and 31 days in March. So totally he is in India for 137 days. Since he is in India for 137 days, and also he is a person of Indian origin. So now let us go back to the provisions once, right? Yeah. So this is the provisions. So this is in relation to proviso. So section 60 shall be substituted as 182 in condition number 2. Basically 61 has one condition. 61, 62. So there are 2. 61 has 2 conditions, 1 and 2. So first condition is 182 days. Second condition is 60 days or more in the previous year. 365 days or more the preceding 4 previous years. So what this proviso says is, Indian citizen who is leaving India for the purpose of employment outside India, Indian citizen leaving as a member of cruise ship, person of Indian origin comes on a visit to India and has Indian sourced income less than 15 lakhs. So for all these three categories, the 60 shall be substituted as 182 in condition number 2. However, if that person is a person of Indian origin, comes on a visit to India and has Indian sourced income more than 15 lakhs, right? If he's a person of Indian origin who comes on a visit to India and has Indian sourced income more than 15 lakhs, then the 60 shall be substituted as 120. So this is the point here. So that is the reason we are having two incomes, 16 and 14 lakhs. So in this case, we just need to check if he is going to come under any of these three criteria, right? So as far as this point is concerned, so which point should we take? Should we take him as Indian citizen leaving India for the purpose of employment? Or should we take him as Indian citizen leaving India as a member of cruise ship? That is totally omitted. That does not come. The first one is Indian citizen leaving India for the purpose of employment outside India, or person of Indian origin who comes on a visit to India and has Indian sourced income less than 15 lakhs. So my view is that I'm going to go for point number C, because I don't find point number A relevant here. Because during the same year itself, he has quit his employment and come back to India. So I cannot take him as Indian citizen who is leaving India for the purpose of employment outside India. Had he stayed outside India for the entire financial year, we could have taken that stand. But since he has come back from India, we could not take that stand, as my personal view. So we should go for point number 3, who is a person of an Indian origin who comes on a visit to India and has Indian sourced income less than 15 lakhs. So that is the point we are going to take. So if he is going to have less than 15 lakhs as his income, it is going to be 182 days or more in the preceding previous year, 365 days or more in the preceding 4 financial years. So if his income is going to be more than 15 lakhs, our condition will be 182 days or more in the previous year and 365 days or more in the preceding 4 financial year, preceding previous years. But in this case, if you just substitute 182 in the condition number 2, automatically condition 1 will become applicable. So that is the reason why they are just having these two limits. However, if his income is more than 15 lakhs, what will happen is, instead of 60, you will substitute 120. So that is the reason why we are solving this question, right? So first is income is 16 lakhs. So since his income is 16 lakhs, what will happen is 120, the condition would be, condition number 1 is, so 6.1, there are two conditions. 6.1, two conditions. First condition is 182 days or more in the previous year. Is this satisfied? Not satisfied. Next condition is 60 days or more, or 60 days or more in the previous year, and 365 days or more in the preceding 4 previous years. This is the normal condition. But he is a person of Indian origin who comes on a visit to India and has income sourced in India more than 15 lakhs. So what will happen is, this 60 should be substituted with 120. So 120 days or more in the previous year and 365 days or more in the preceding 4 previous years. So what will happen here? See, is he in India more than 120 days? Yes. So he left India only on 7/4/2022. So obviously he would have satisfied 365 days in the preceding 4 financial years. This is satisfied. Since this is satisfied, he will be deemed to be, he is a resident and ordinary resident. Ordinary resident, because he would not satisfy both the conditions of 9 out of 10 years to be a non-resident, and also he will not satisfy the condition of 729 days in the preceding 7 financial year. So both these conditions will not be satisfying. So that is the reason he'll be a resident and ordinary resident if his business income in India is going to be 16 lakhs, right? So in this case, now we should compute his total income. So as if he is deemed to be resident and ordinary resident, since he is a resident and ordinary resident, what will happen is, the entire global income will be taxable. So here first 32 lakhs was the turnover, and we have deemed here that 16 lakhs is income. He can go for 4480. Even though he's going for 4480, you have an option to declare higher income. So had he earned only 8%, 6% or 8%, had this income not been given, we could take a stand that only the 8% or 6% is taxable. But in this section itself, such amount or such other higher amount has to be claimed as has been claimed by the SSC to be earned. Words. So that is the reason we are going here with this method. Business income 16 lakhs, right? Next point, salary income in UK 6,56,000. Even though it is since he is a resident and ordinary resident, the entire global income is taxable. Salary income 6,56,000 minus standard deduction of 50,000. It is going to give me 6,06,000, right? 6,06,000. Next, he invested in equity shares of UK Inc. He earned a dividend of rupees 60,000 during the previous year 22-23, and he earned interest. He paid interest of 20,000. So this interest deduction is limited to 20% of the dividend income. It is to be taxed under the head dividend income, taxable under the head income from other sources. What is the dividend income? It is 60,000 minus the interest up to 20% is taxable, can be claimed as deduction, right? So what is 20% of 60,000? It is 12,000. What is the interest I have paid? 20,000. So only 12,000 I can claim it as deduction under section 57. So I'm going to get 48,000 as income from other sources, right? So 48,000. Next, is there any other income which I have left? No, that's it. So my total income would be 6,06,000 plus 16 lakhs plus 48,000, which is going to be 22,54,000. So this is my income if the business income is 16 lakhs. Now let us go to condition number. Go to assumption number B. If his income from business is 14 lakhs. If his income from business is 14 lakhs, what will happen? 612 conditions. 612 conditions, correct? First condition is not satisfied. 182 days condition, not satisfied. Condition number 2, what will happen is, since he is having less than 15 lakhs of income, you will be having only 182 days or more during the previous year and 365 days or more during the preceding 4 previous years, right? So this is also not satisfied. Since this is also not satisfied, he will be a non-resident. Assessee is a non-resident. If he is a non-resident, income which is deemed to accrue or arise in India, or which is received or deemed to be received in India, is alone taxable. So in this case, his business income of 14 lakhs alone will be taxable. Income taxable in India is 14 lakhs. That's it. So there comes an end to this question. The only point from the suggested answer is, suggested answer solves this question by having, so in the suggested answer, we only have the non-resident variant alone. We do not have the resident variant. So even in the non-resident variant, they are taking 44 AD and having 6% of the 32 lakhs as income. So I slightly differ from that, and I am of the view, and that is also given in the law, that non-residents are not eligible for presumptive taxation, with all due respects, right? So now let us go to question number 7. Now let us go to question number 9. As far as question number 9 is concerned, again it deals with residential status questions. So here we just need to solve the question for 3 variants: resident and ordinary resident, resident but not ordinary resident, and non-resident. So what we need to remember here is, so for a resident and ordinary resident, basically resident but not ordinary resident and non-resident, there is only one variation which is available, right? Profession which is controlled from India. So other than that, all the provisions are similar for a non-resident and a not an ordinary resident. So for a resident and ordinary resident, the global income is taxable in India. For a not an ordinary resident and non-resident, the income which is taxable in India is income which is received or deemed to be received in India, which income which accrues or arises in India. So only those 2 things are taxable for not an ordinary resident and non-resident. right? So now let us go to the question and solve the question. What does the question say? So salary received in India from a former employer of UK, 1,40,000. So 1,40,000 is taxable for all the three, since it is received in India. So any income which is received or deemed to be received in India, or which accrues or arises or deemed to accrue or arise in India, all those things are taxable for all the assessees, right? Sorry, just a minute. Yeah. Now let us come back. So income from tea business in India, a tea business in Nepal being controlled from India. So income, if it is from a business which is controlled from India, this alone is taxable only for resident but not ordinary resident. That is the only difference between not an ordinary resident and non-resident. In all the other cases, resident but not ordinary resident and non-resident, the taxability will be similar. ஒரே ஒரு பாயிண்ட் மட்டும் தான், income from a business which is controlled in India, that is taxable for resident but not ordinary resident, but it is not taxable for non-resident, right? So here for resident every income is tax. If it is income, it is taxable, right? So டக்குன்னு இந்த மாதிரி ஒரு கொஸ்டின் வந்துச்சு, டைம் இல்லை அப்படின்னா, what you can do is take all the income, put it as taxable for resident. Take all the income, put it as taxable for resident. So almost you will be getting, for this one part you will be getting the marks. Or last minute I'm not having time in the examination, so what is to be done? You can just take all the income is taxable for resident and ordinary resident. Just check if it is resident or if it is income or not. If it is income, tax it. If it is not income, don't tax it. So majority of the cases, all the incomes will be taxable for resident and ordinary resident. So for even if you do not know point number 2 and point number 3, just go for point number 1, you will be getting good marks, right? Number 3, interest on company deposit in Canada, 1/3 is received in India. So whatever amount is received in India, it is taxable for all the people. If it is received outside India, it is taxable only for a resident. So for an income to be taxed for a resident but not ordinary resident and non-resident, it should accrue or arise in India, or it is to be received or deemed to be received in India, right? Next point is profit from a business in Mumbai controlled from UK. So profit from a business in Mumbai, since it is business in Mumbai, it is deemed to accrue or arise in India. It is taxable in India. Past profit from business in Tokyo remitted to India. So this is not at all an income. It is just an application of income. So I've earned in Tokyo and I'm just remitting it back to India. So this point is not income at all. Since it is not income, it is not taxable in India. Next, income from property in India. So since property is in India, it is deemed to accrue or arise in India. Hence, it is taxable for all the three categories of people. Next, income from property in London, but it is received in Delhi. Since it is received in Delhi, it is again taxable for resident and ordinary resident, not an ordinary resident and non-resident, right? Income from a property in London, but received in Canada. So it is not deemed to accrue or arise in India, neither it is received in India. Hence, it is not taxable for not an ordinary resident and a non-resident. It is taxable only for resident and ordinary resident, right? Next point is income from a business in Turkey, income from a business in Jamaica, but controlled from Turkey. This is not taxable for both the people, both non-resident and not an ordinary resident. It is taxable only for resident and ordinary resident. So with this, the question ends. So the total income is 7,35,000 for resident and ordinary resident, and for not ordinary resident, it is 4,55,000, and for non-resident, it is 4,45,000. Right? Okay. Now let us go for the next chapter. So with this, we are completing questions on two chapters. One is income from house property, and the other one is residential status. So maybe you can expect one question from all the above 7 questions we have discussed. At least from the concepts, you will be getting one question. Right. Now let us go to the chapter of salaries. Yeah. Now let us go to question number 8. Sri Ashutosh has been provided with a furnished accommodation in a city having population of 14 lakhs as per latest census. Municipal value of the house owned by the employer is 80,000, whereas fair rent of the house is 1 lakh. His salary details are as under: basic 25,000 per month, allowance for increased cost of living, which is DNS allowance 5,000 per month, children's education allowance 3,000 per month. He has one son and 2 married daughters. Furniture details are as under. So here, this was just a question which is copied as it was given in the question, but there is just one small thing. Yeah. You can just omit this part. So all these things can be omitted. It is just a repetition, right? So we need to compute the gross taxable salary for Ashutosh for the assessment year 23 to 24. First one is 25,000 per month is the basic salary. So basic salary is entirely taxable. 3 lakhs it is taxable. Next one is DNS allowance, entirely taxable. Children's education allowance, it is 36,000. 3,000 into 12, it is 36,000. Of which 100 per month per child, up to a maximum of 2 child is exempt. So 2,100 into 2 into 12, 2,400 is exempt. And the taxable children's education allowance is 33,600. Next is he is provided with a furnished accommodation in a city. So furnished accommodation பொறுத்த வரைக்கும் we need to value it. So for the purpose of valuing rent-free accommodation, so value of accommodation is 10% of salary. Let us just get back to the provisions for that in simply just small provisions. Valuation of a rent-free accommodation. Rent-free accommodation. Yeah, this point. So as far as valuation of the rent-free accommodation is concerned, if it is other than a government employer, right? If it is unfurnished, 15%. If the population is more than 25 lakhs, 15% of the salary. If it is between 10 lakhs to 25 lakhs, it is 10% of the salary. If it is in other areas, 7.5% of the salary is taxable. If the unfurnished accommodation is owned by the employer, if it is taken on rent by the employer, what will be the thing is lower of the lease payment which is payable by the employer or 15% of salary. So whatever is lower, we need to take that, and from that whatever is rent recovered in all the cases we need to deduct the same. If it is a furnished accommodation, whatever is value as per 2, that is this column, plus 10% of cost of furniture per annum is to be taken as the value of perquisite. If the furniture is hired from the third party, what we need to do is value as per 2 plus the higher charges which is payable by the employer minus charges which is paid by the employer. So in all the cases, whatever charges is recovered from the employer, it can be claimed as deduction. Okay. If it is a furnished accommodation and accommodation is taken on rent by the employer, same case as per 2. If it is if the furniture is owned by the employer, 10% of the cost. If it is hired from the third party, higher charges paid. Right? That's it. So that is the brief provision. One point which we just need to say is what is the meaning of the term salary. Here alone, the meaning of the term salary will include all the pay and allowances, bonus, everything, anything and everything after taking all the exemptions. Right? So salary includes pay, allowances to extent taxable, allowances to the extent taxable. Right? So this is one point which we just need to remember. So allowances to the extent taxable, bonus or commission or any monetary payment by whatever name called, but it will not include salary for the DA if it does not form part of salary. So here in this case, this is DA forms part of salary, hence no issues. Employee's contribution to PF, valuation of perquisites, right? So this is the provision here. So let us get back to the question. So as far as our question is concerned, rent-free accommodation, here it is said as 14 lakhs. So since it is between 10 lakhs and 25 lakhs, 10% of the salary is to be taken as value of the accommodation. Here there are two parts to the question. One is it is a furnished accommodation. First one is valuation of the accommodation. Next one is valuation of the furniture. Just we need to add it, right? That's what we are doing now. So first let us find out the value of the accommodation. So value of the accommodation is 10% of salary. Let us find out the salary. Basic is 3 lakhs. DA is 60,000. The taxable education allowance. The taxable education allowance is 33,600. So this entire 3,93,600 is to be taken as the total of this 10% is taxable as value of accommodation. Then we need to go for value of furniture. So as far as value of furniture is concerned, if it is hired, we need to take the higher charges. If it is owned by the employer, we need to take 10% of the cost. That's it. So TV, it is hired, 2,000 is the higher value. That is to be taxable. That is to be taken as taxable value. Refrigerator, 10,000 into 10%. That is to be taken as the taxable value. 10,000 into 10%, 1,000 is to be taken as the taxable value. 5,000 into 10% washing machine, that is to be taken as taxable value. In case of other furniture, there are two things. One is hired furniture. The higher charge is 12,000 and 10% of 20,000. It is owned furniture. So it is 12,000 plus 2,000, which is 14,000. So in entirety, it is 17,500. And this 17,500 is the taxable value of the entire furnitures, right? So here the gross taxable salary is 4,50,460. So with this question ends. This is one small good question which deals with valuation of perquisite, right? Now let us go to question number 9. So as far as question number 9 is concerned, we need to find out the taxable value of perquisite for the assessment year 23 to 24 in the following cases. First, the Star Public School, Chennai, is owned and maintained by XYZ Limited, a manufacturing company. Books of the accounts of the school and XYZ are maintained separately. X is an employee of XYZ Limited. The following family members of X are students in Star Public School. First one is son of X. Cost of education in a similar institution 4,800. Amount charged from it X is 800 per month. Dependent brother of X. Cost of education in a similar institution 6,600. Amount charged from X is 1,600. So let us take this individually. So first point alone, this question is from December 2019 MTP. Here I just have one reservation which is to be discussed, right? If the school is, let us first go and discuss the provision here, as we did it for the previous one. Let us go and discuss the provision here, right? Free or concessional education, how to value the perquisite. In case of free or concessional education facility, amount taxable if the education is owned by the employer, or free education facility is due to his employment, cost of such education in a similar institution in a nearby locality. In any other case, whatever expenditure is incurred by if the education institution is not owned by the employer, if the expenditure is incurred by the employer minus the amount which is recovered from the employee is to be taken as the value of perquisite. One point which we should remember here is, if the perquisite value is less than 10,000 per month, basically if the amount from column number 2, whatever we are finding, if it is less than 1,000 per month, then the entire perquisite shall not be taxable. This is what is given in law, right? In rule 3 sub rule 5, this is what is given. And even in CA Institute study material, in all those problems, they are taking this view that this 1,000 rupees, if the perquisite value is less than rupees 1,000, it is not taxable. That is the view which is taken. However, the CMA intermediate in its intermediate textbook and also in the suggested answers, it is taking a view that this 1,000 is an exemption, similar to what we have seen here. 100 per month per child, this is an exemption. Basically, they are taking it as a deduction from the children's education allowance, right? They are treating this 1,000 also in a similar manner, and they say that of this 4,800, what is 4,800? This point, cost of education in a so cost of education in a similar institution. This is 4,800. So this is more than 1,000. Hence, it is entirely taxable is one view. But however, the view which is taken by the CMA intermediate textbooks and also by the suggested answer consistently is that of this 4,800, 1,000 is exempt. But what is given in law is up to 1,000 it is exempt, more than 1,000 it is fully taxable. This is the dichotomy which exists between the institute stand and the what is given in law. What is to be done for the exams? All these things are there. Let us leave it at least in the last day of the examination. What is to be done for the examination? As far as examination is concerned, if you have time, go for 2. Write both the alternatives. Alternative 1, what is given in the textbook. Alternative 2, what is correct. If you are not going to have any time, go for what answer is given in a textbook. Take the stand which is given in a textbook. I'll just request you to write both the stands if this a similar question comes in your examination, for you to not have any chances to lose any marks, right? So what is given in the books of the CMA book and also in the CMA examinations suggested answer is that 4,800 is the value of taxable perquisite. Of this, 1,000 is exempt and 800 is recovered from the employee, right? So basically, it is going to be 2,000 which is taxable. Sorry, 3,000 it is taxable, and 3,000 into 12, 36,000 is the total amount of perquisite, taxable perquisite. However, this 1,000 exemption is not available for a relative child. It is available only for his children, right? It is available only for his children. Rule 3.5 also agrees on the same. Rule 3.5, which is given in the Act, says is, as per it will be given as a last line, it will be given as a proviso. It says that if it is your child and if it is up to 1,000, it is exempt. Yeah, so that is the point. Here again, what will happen in case of a dependent brother, this 1000 exemption is not available. Hence 6600 minus 1600 into 12 is to be taken as the value of perquisite. Hence the entire amount of 96,000 is taxable. This is view number one. Alternatively, what is actually correct? What is actually correct as per law? Right? So this is an alternative, and in the examinations, if you're just going to give this alternative, you're going to get definitely a good impression of the examiner, right? So as per rule 3.5, if the value is less than rupees 1000, if the value of the perquisite is less than rupees 1000, the entire perquisite is exempt, right? If the value is more than rupees 1000, no amount is exempt. Let me show you the rule itself, right? Let me show you the income tax rule itself. Just give me a minute. I'll show you the rule. Yeah. Rule 3 speaks about valuation of perquisites in this rule 3.5. See here, rule 3.5. This is what is given. Provided that where the educational institution itself is maintained by the owned and employed, is maintained and owned by the employer, and the free educational facilities are provided to the children of the employee, or where such free education facilities are provided in any institution by reason of his being in employment, nothing contained in this sub-rule shall apply if the cost of such education or value of such benefit per child does not exceed rupees 1000 per month. Up to 1000 not taxable, more than 1000 fully taxable is what is given in the law, and is what is actually to have been taken as a stand. In the CA study materials, they are taking the stand, but however, in the CMA study materials, they are taking a different stand. So I've just said you all both these stuff. Just be cautious while writing this in examination, right? If you are just going to have the same question or a similar question, try to go for two alternatives. So in alternative, what will be the answer? So basically, it is going to be 4,800 minus 800. It is 4,000 minus into 12. It is going to be 48,000 for A, and for B, who is the dependent brother, it is going to be 1,600, 6,600 minus 1,600. It is 5,000. 5,000 into 12, 60,000. There is no change in point number B, since this 1,000 deduction does not come here. So it is going to be 48,000 plus 60,000. Hence your answer will be 1,08,000. So this is an alternative solution. Now let us go back to, so this is one of the MTP questions of 2019 set number 1. Now let us go to question number 2. See point number 2. As far as point number 2 is concerned, Mr. Mohan is a general manager in ABC Limited. He engages a domestic servant on a monthly salary of rupees 3,000. The entire salary, that is 36,000, is paid by ABC Limited to the domestic servant. Salary is paid by Mohan, and ABC Limited reimburses the entire amount. Since the entire amount is reimbursed and it is yeah. Since the entire amount is reimbursed, the entire amount is taxable. It is personal expenditure which is made by the employer. The entire amount is taxable. So this 36,000 is entirely taxable. Point number 3. Mr. Rakesh is employed by the company. He has been provided a car of 12,200 cc owned by the employer. Cost of the car is 5,10,000. The expenditure incurred by the company on maintenance of the car. So a company is maintaining the car also. Maintenance is by the company. Petrol 56,000, driver 42,000, maintenance 15,000. The car is used only for private purposes. A sum of rupees 14,000 is required from Rakesh. So first, let us go and discuss the provisions in relation to car, right? So as if the motor car is owned or hired by the employer, and it is wholly and exclusively used for his professional duties, it is not taxable as a perquisite if the requisite documents are maintained, right? If the motor car is owned or hired by the employer and it is used wholly and exclusively for the purposes of personal purposes, if it is used wholly for personal purposes, and running and maintenance expenses are met by the employer, what will happen is depreciation on the original cost at 10%. If it is hired, you should take the higher charges, plus running and maintenance expenses which is incurred by the employer, minus the amount which is recovered from the employee if the engine capacity is less than 1.6 liters, that is 1,600. If it is going to be more than 1.6 liters of cc, depreciation at 10%, higher charges, running and maintenance expenses, the amount recovered from the employee, no changes. Let us go to the second part. If the motor car is owned or hired by the employer, it is partly for performance of duties and partly for private purposes. And the expenses are met by the employer. If this is the condition, 1,800 per month. If chauffeur is provided, plus 900 if the engine capacity does not exceed 1.6 liters. If the engine capacity exceeds 1.6 liters and the motor car is owned or hired by the employer, and it is partly for the performance of duties and partly for the performance of private purposes, and it is 2,400 per month, and if it's chauffeur is provided, it is plus 900 per month, right? If motor car is owned or hired by the employer, partly for performance of duties and partly for private purposes, and expenses are met by the employee. If it is met by the employee, simple, divided by 3. So 1,800 badala 600 per month, plus chauffeur, there is no difference, plus 900 for chauffeur. Here also it is going to be 900 per month and 900 for chauffeur. That's it. So this is the entire provision, just a small summary in relation to the car. Now let us go to the answer. So what is this? The car expenditure is incurred by the company. It is owned by the employer. It is owned by the employer. It is used only for private purposes. The expenditure is incurred by the company. So what will happen? 10% of the cost. 10% of the cost. And all the expenses is to be taken as the value of perquisite. Here 14,000 is recovered from Rakesh. That 14,000 is to be claimed as deduction. So minus 14,000, 1,64,000 minus 14,000, it is going to give me 1,50,000. So that is going to be my answer for this part of the question. Right. So with this, our this question is also completed. Let us now go to the next question. Better, what we'll do is we'll go for the next question in the next recording. So I'll just upload this recording in the YouTube, and in the next recording we'll just continue. Right. Bye bye.